Hello everyone, Mark Pruitt here with Strategic Estate Planning Services. Today, we are diving into some critical information that should give you a comprehensive lay of the land. This is a strategic market update. Feel free to share it and pass it around to anybody that you think it would be helpful for. It's an ever-changing landscape with the highs and lows, and I'm here to shed some light on where we think things are headed. I want you to know this isn't about politics, it's about policy. We've seen markets fluctuate, and I'd like to share some insights that can provide direction for the future. So let's start with some good news first. The House has passed a tax bill, and we're hopeful that the Senate will finalize it soon, potentially sometime in May. Key points in the bill include no taxes on Social Security, no taxes on tips, no tax on overtime, and a potential reduction in the individual and corporate brackets. This puts more money in businesses' pockets, leading them to spend more on wages, on benefits, marketing, and hiring. And this concept of more consumer and business spending boosts the economy. And additionally, not taxing Social Security would remove a double taxation issue, as it wasn't taxed before the 1980s and was only added for additional revenue. Personally, I was skeptical about the tax bill passing in the House due to its very narrow margin, but however, it passed, suggesting a better chance in the Senate. And if enacted, this bill could significantly boost the economy by impacting corporations and individuals regardless of age. The additional funds would allow people to spend and infuse money back into the economy, which could lead to substantial growth. Now, regarding inflation, the consumer price index was 3% in January and has decreased to 2.8% in February, which is encouraging as it's the lowest since April of 2021. And similarly, the producer price index, PPI, has dropped from 3.7 to 3.2. And additionally, jobless claims are also down, which I monitor closely and often discuss in my videos. Now in 2024, manufacturing jobs saw an average monthly loss of 7,000 jobs a month. However, after the new administration took office in January 21st of this year, there was an expected addition of 5,000 jobs in February for manufacturing, but the actual addition was 10,000 jobs, indicating a positive start and trend in manufacturing. Major companies are returning to the United States, and there will be no tariffs on those operations. Moreover, $2 trillion from global companies have already been invested in technology and larger businesses in the U.S., reflecting a strong interest in job creation within the country. David Solomon, CEO of Goldman Sachs, highlighted the pent-up demand from businesses that they are ready to invest, which is becoming increasingly evident with frequent announcements from those companies. I want to clarify some misconceptions about tariffs. The media often fails to explain them properly, and they're very narrow focused as they don't really explain them properly. So I'm going to try to break this down as simply as I possibly can. The business community understands tariffs and knows that 65% of new hires come from small businesses. That's significant and contributes to lower jobless claims. Small businesses also push for less regulation and deleveraging, which means reducing government size and expenditures. It frustrates me that past administrations from both parties have failed to address this. And we're looking at an overdue global economic reset, not just a U.S. reset, in my opinion. And unlike normal businesses that hire during expansion and lay off during contraction, government jobs often remain unchanged once filled. Like normal businesses, the government should hire and fire based on economic conditions, need, and because it involves our money, the taxpayer. Recently, someone who works for the government asked me, they said they were curious about the possibility of replacing most government workers with AI. That's what they heard. I wanted to clarify that that's not entirely accurate. Instead, the focus is on updating outdated software to make jobs easier, like automating processes that were previously done by hand. also allowing computer systems and departments in many cases that have never talked to each other are now going to be connected to communicate to each other, which helps with fraud and waste. While some layoffs may occur, those affected could transition to the private industry, which could operate more efficiently. This idea applies across the board with both public and private sectors, and there are always individuals who don't perform their jobs well or should seek other employment or are just simply no longer needed. So improving efficiency by addressing such issues is a significant but necessary task. Happens everywhere in all business. And when it comes to long-term planning, there's a stark contrast between China and the United States. China has a 100-year outlook with clear goals and a disciplined approach to achieving them. In contrast, the U.S. typically operates on a quarterly basis, struggling to even pass a budget with that time frame. And this short-term perspective is problematic in my opinion and underscores the need for a more strategic long-term approach. Now, moving on to tariffs and trade deficits. Take a look at the following charts that we're about to show you here on the screen. If you notice the first one, it says the biggest trade deficit. Look in the far left corner and you will see the U.S. leading at 1.1 trillion deficit. That is not a positive thing, that's a negative thing. So when you hear someone say that they're ripping us off, this is what is being referred to in regards to a trade deficit. And when you see the next, even second, it's not even close to where we are. They're at 245 billion, which is India, and the UK's 233 billion. And then it goes significantly down from there in Turkey and France and the Philippines, all the way to Romania. So that's our biggest trade deficit, and we're the ones that are being hurt the most for that. And that means that's what's already baked into the prices that we are paying. They're charging us, bottom line, way more than we are charging them. The next proof of that next chart is this, the biggest trade surpluses. So who's charging the most to countries? Look who's number one, far upper left, says China, 593 billion in a trade surplus, followed by Germany, Ireland, Singapore, Saudi Arabia, Switzerland, Russia. You see the list there, and we're not even close to that because our deficit is so big. Now, this considerable disparity means that higher tariffs are already factored into U.S. costs. This means you're already paying it. It's making prices higher for American consumers. And if the U.S. raises tariffs further, other countries may not be able to handle that impact because their economies are not structured to absorb such cost as the U.S. is. There's a mention of the Dirty 15. You're going to begin to see that and hear that now. These are the 15 countries, and as many as 21 that they may list before it's over with, but these are the top countries that impose the highest tariffs on the United States. And these countries are already beginning to negotiate down their tariffs as they cannot afford the financial strain. This isn't just about trade as well. It's also about a drug war, particularly with China, Canada, and Mexico. Being involved in the trafficking of fentanyl, huge. As Canada and Mexico help the U.S. with the border control, the administration stated those tariffs will be reduced in Canada and Mexico, both. Markets react to these developments often in a volatile manner, and they are influenced not by any single president, but by policies, taxation, and overall certainty of the economy and the environment of the economy. Addressing these issues, particularly tariffs and regulatory inefficiencies, is crucial for market stability and economic growth. Now, regarding inflation, it has decreased recently, but it's important to note that inflation is often influenced by various decisions, including those of the Federal Reserve, which has a history of being reactive rather than proactive. Lowering interest rates is just one method to reduce inflation, but another effective way is through less regulation. When regulations are reduced, it decreases production costs for businesses, which can result in lower prices for consumers. Now, small businesses play a significant role in the U.S. economy. According to the U.S. Small Business Administration, small businesses represent 99.9% of all U.S. businesses. Think about that. Small businesses are also responsible for creating a large number of jobs in the economy, with an estimated 60 to 70% of new jobs in the U.S. coming from small businesses. Now, this shows how integral they are to the economy's growth and employment in the country. And reducing government spending, deregulating, and making it cheaper to deliver goods can help lower inflation. These measures can result in reduced costs both domestically and for imports. Countries rely heavily on the American market for their economies. Think about that. They want our dollars. They can't afford higher tariffs because their prosperity is not on par with that of the United States. As a result, many are already negotiating to lower the tariffs, and it is anticipated that the top 15 countries with the highest tariffs on the U.S. will come to the negotiating table soon. The impact on markets is significant, and it will take some time to stabilize these changes. We do expect that markets will start reflecting these adjustments this year in a positive note. Currently, there's about 36% chance of a recession based on our ongoing assessment, and this probability could increase, but it's not firmly on the negative side yet. So the future is uncertain and no one can predict it perfectly. But whether we face a recession depends on various factors, such as passing new tax legislation, boosting manufacturing, and maintaining lower jobless claims. These actions are expected to stimulate the economy, not decrease it. Now, it's important not to panic over your financial accounts. You shouldn't aim to mirror the market unless you're extremely aggressive. Younger investors, say in their 40s and even 50s, might have the time to take such risk, but many do not. Diversification is crucial and prevents your portfolio from mirroring market volatility, and that's a good thing. As interest rates lower, the value of bonds inversely rise, stabilizing investments during unstable market periods. And this trend is expected to continue with potential interest rate reductions in this year, further benefiting those bond values. Now, if you have fixed indexed annuities, there's no need to worry. Annuities offer a level of safety because they can provide consistent income for life, regardless of the market conditions. And proper planning involves diversifying your investments, and including annuities can provide stable income to help withstand market fluctuations. You know, fixing a $36 trillion deficit isn't quick. It could take decades. Both parties have spent excessively, and that needs to stop. The dollar's strength is crucial, and I monitor it daily. And despite various claims, the dollar has strengthened because it's the global trade currency. Even though you might receive alarmist emails, the dollar remains strong. And the world revolves around two things, the US dollar and the 10-year Treasury note, because global investors also seek returns, and they are investing heavily in our economy and in our nation. The inflow of money can give the government a false sense of limitless spending ability, and interest rates affect this dynamic. As they rise, more global investment flows in. However, we must hope for fiscal responsibility to use these funds wisely, which is our tax dollars, and address our long-term spending issues. You know, I always ask the following question: do you think the stock market will be higher or lower 10 years from now? Think about that. People usually answer higher. And based on history, I agree with that. And the key is to have solid income during retirement that allows you to weather adjustments along the way. And in order to do that, it takes strategic planning, and that is what we are here to do. If you have questions or concerns, give us a call at 1-800-381-8870 to speak with myself or one of our advisors. Thank you for tuning in. Don't forget to subscribe to our channel for other market updates as well as other helpful videos. I'm Mark Pruitt with Strategic Estate Planning Services, and when it comes to your money, it pays to be strategic.